Hey everyone, it is Troy Stavros with Cornerstone Realty Associates. I want to wish you a happy new year, and it is time for our monthly market update as well as our year-end update and predictions for 2026 for the East Tennessee and Knoxville housing market. So let's talk about what we're seeing in East Tennessee and in Knoxville, specifically using the latest December 2025 numbers and the year-end 2025 wrap-up. Then I'll share what it likely means heading into 2026, especially with the big news that dropped yesterday that we will talk about. First, the big picture. Both markets moved towards a more balanced feel in 2025. Inventory is up, homes are taking longer to sell, and buyers have a little more room to negotiate than they did a year or two ago. But Knoxville and the broader East Tennessee region are not behaving exactly the same, and that's important. So, December 2025, Knoxville versus East Tennessee. Let's start with sales and demand. In December, closed sales were up in both markets year over year, but Knoxville was stronger. Knoxville's December home sales were up 12.5%, while East Tennessee was up 7.5%. So closings improved across the board, but Knoxville had the bigger jump. Now, when we look at the pipeline, that is homes going under contract, pending sales were up in both markets too, but the region jumped a lot more. Knoxville's pending sales were up 6.1%, while East Tennessee's pending sales were up 19%. What that tells me is Knoxville had a strong December finish, but East Tennessee's momentum into early 2026 may be even stronger because pendings often lead to future closings. Next, let's talk about inventory and market pace, because this is where the tone of the market really changes. Inventory increased in both markets year over year, but Knoxville's increase was dramatic. Knoxville's inventory was up 31.6%, while East Tennessee's inventory was up 16.9%. Even with that big inventory bump, Knoxville is still the tighter market. Knoxville's absorption rate in December was about 2.9 months of supply. That means that if you were going to sell all of the inventory that was currently on the market, it would take 2.9 months to sell it all, while East Tennessee was around 4.4 months. So here's the plain English version of that. Knoxville is still moving faster, and it still leans a little more seller-friendly than the region as a whole. East Tennessee overall is more balanced, with buyers having more choices and more leverage. Now, let's talk about pricing, because this is where Knoxville looked even softer in December. Knoxville's median sold price was down 5% year over year to $380,000. East Tennessee's median sold price was only down slightly, about 1%, to $370,000. So both markets saw some softening at the end of the year, but Knoxville's dip was more noticeable in December. And finally, days on the market increased in both places. Homes are taking longer to sell than they were last year, and that's consistent with a market that is normalizing. It's not hit the MLS on Friday and you're under contract by Sunday in most cases anymore. Pricing and conditions matter again. So let's look at the year end of 2025 and what the full year tells us. So zooming out to the full year, East Tennessee finished 2025 with home sales up 3.7%, pending sales up 6.1%, inventory up 12%, and the median home price up about 1.4%. Knoxville finished 2025 a little differently. Home sales were basically flat, around 0.2%. Pending sales were up 1.3%. Inventory was up 8.7%. And the median price was up about 0.37%, essentially flat. So the takeaway for this is East Tennessee as a whole had a bit more growth and momentum in 2025, while Knoxville was more of a steady but cooling story. More supply, more time on the market, and pricing that ended the year basically flat overall. If you want the Knoxville versus East Tennessee story to feel local, the next step is looking at the surrounding counties that we serve because they're not all moving the same way. Using the December 2025 versus December 2024 snapshot and the full year 2025 versus 2024 numbers, here's what stands out in Roane, Knox, Anderson, Loudon, Sevier, and Blount counties. So let's start in Roane County. In Roane County, demand is up, inventory is up, and prices jumped. In December, the year-over-year numbers showed inventory up 23.6%, pending sales up 14%, median price up 25.21%, coming in at $337,450, and the median sold price per square foot coming in at $189 per square foot. The full year numbers have inventory up 20.1%, pending sales up 14.3%, and the median sales price up 3.17% for the whole year and coming in at $325,000. So Roane looks like a more activity, more choices market. The big December price jump is likely heavily influenced by what sold. That's called mix shift. So if you see a big jump in the median sales price number, it probably means there were a bunch of more expensive houses that sold that made that number trend as high as it did. But when you look at the annual number or the year-end number, what you see is a much more modest increase. You only see 3.17% full year increase in the median sales price. So with pendings up for both the month and the year, Roane is clearly catching demand, often spillover from the Knoxville area and lake access lifestyle pockets as well, as much of Roane County is on the lake as well. So what to watch for in 2026? If rates stay low, Roane should keep seeing solid traffic, but sellers can't rely on that 25% pricing headline. The steadier story is moderate annual appreciation and improving demand in Roane County. How about Knox County? Knox County, the metro anchor, is showing clear signs of normalization. Inventory is up significantly, nearly 29% year over year in December, with pending sales also up 10%. Price growth is mild. Median sales price rose just 2% in December, and the full year gain was just above 2%. This suggests a market that's regained balance after ultra-competitive years with more choices for buyers and steady, sustainable price trends. So Knox is still the area's bellwether, more inventory, more buyers coming back, but prices are stabilizing rather than surging. Let's look at Anderson County. Supply is rising faster than demand, but prices held up. So in December, the year-over-year inventory was up 37.4%. That's the largest supply jump in this county set that we're looking at. Pendings were up 4.8%, and the median sales price was up 3.92%, coming in at $336,700, with the median sold price per square foot coming in at $223 per square foot. When we looked at the full year, inventory rose 11.9%, pendings rose 0.6%, and the median sales price rose 1.22% to $325,000. So Anderson is the most inventory-led story here. Supply expanded meaningfully while demand growth was mild. So prices still ticked up, but only slightly across the year, which fits a market that's moving towards balance and giving buyers more leverage than they had had. So if looking to 2026, if there is rate relief, it could bring buyers back. Anderson has the inventory to absorb them without instantly turning into chaos, so you may see activity improve before you see big price acceleration. Let's look at Loudon County. So Loudon County has fewer new opportunities in December, but prices are high and still rising. In December, the year-over-year numbers in Loudon County, inventory was up 9.9%, pendings were up 15.7%, and the median price was up 6.23% to $497,000, with the median price per square foot coming in at $240 per square foot. The full year numbers had inventory up 12.3%, pendings up 8.6%, and the median price coming in at $520,000, up 1.96% for the year. So Loudon stays expensive relative to many surrounding counties, and it tends to behave like a hybrid of move-up plus lifestyle retiree demand. December looked strong on demand, pendings were up, but the full year appreciation is modest, again pointing to normalization and buyers being choosier at higher price points. So what do we watch for in 2026 in Loudon? Lower rates will help here, but Loudon is still more payment sensitive at these price levels. Expect a split market with turnkey homes that do well, but anything dated, oddly located, or overpriced will still need price improvements or concessions. Let's look at Sevier County. Sevier County is the most rate sensitive and the most second home mix driven. In December, the year-over-year numbers in Sevier County, inventory was up 5.45%, pendings were up 22.74%, the median price was up 8.33%, coming in at $585,000, with the median sold price per square foot coming in at $321 per square foot. The full year numbers had inventory up 16.7%, pendings up 15%, and the median price up 2.22%, coming in at $460,000. So Sevier is its own animal because of cabins, overnight rental, and second home dynamics. So month-to-month medians can swing a lot based on higher-end sales closing. The theme that matters, pendings are strong both in December and for the year, which usually signals improved near-term closings, but full-year price growth is relatively modest, suggesting that buyers pushed back on aggressive pricing in 2025. So what do we watch for in 2026 in Sevier County? If rates remain lower, Sevier can reaccelerate quickly on activity. The caution is that pricing depends on the investor second home appetite and the mix of what sells, so don't overread a single month's median. In Blount County, December demand popped and the full year was steady and balanced. So the year-over-year numbers in December for Blount County, inventory was up 7%, pendings were up 38.8%, that's the biggest pending surge. The median price was up 1.07%, coming in at $382,860, and the median sold price per square foot came in at $230 per square foot. When we look at the full year numbers, inventory was ultimately up 9.1%, pendings were up 10.7%, and the median sales price was up 1.27% to $389,900. So Blount looks like a steady market that's starting to heat up. December pendings jumped hard, but prices barely moved. That is a classic sign that demand improved while buyers still had enough supply and negotiating room to prevent rapid price inflation. So what about 2026 in Blount County? If that pending strength carries into spring, Blount is a prime candidate for faster sales pace and fewer price cuts, even if appreciation stays modest. So, a quick summary. Anderson is supply heavy and more buyer friendly. Roane and Blount show improving demand. Loudon is high priced and picky, and Sevier is momentum driven and mix sensitive. Rates getting lower should lift activity across all five, but the counties with the biggest inventory gains may see more transactions before they see big price jumps. Now, Knoxville and East Tennessee are the big buckets, but most people watching this live in specific communities. So let's zoom in on three markets people ask about constantly, those being Farragut, Lenoir City, and Tellico Village. Same idea here. We'll use the December 2025 numbers plus the full year 2025 story, and then I'll tell you about what I'm watching as we head into 2026. Let's start with Farragut. Farragut is tight for the price point. So, December 2025 versus December 2024, home sales were up 46.9%. Pending sales were up 25.9%. Inventory was up 4.3%. The median sold price was up 1.87%, coming in at $657,000 in Farragut, and the absorption rate was about 2.46 months. The average days on the market were 71 versus 78, so up about 22%. But here's what that means. Farragut is still one of the clearest examples of a market that is supply constrained. Inventory is only slightly higher than last year, but demand improved sharply in December. And that's why Farragut can feel seller leaning even when the broader region feels more normal. When we look at the full year numbers, 2025 versus 2024, sales were up 4.7%, pending sales were up 1.6%, inventory was up 4%, and the median sold price rose 3.48% to $708,850. Absorption was up around 19% over the year. It loosened a bit, but it's still tight. So, what about 2026 in Farragut? If rates can get below 6%, Farragut tends to feel it through competition. Turnkey homes that show well should still move quickly, but it'll stay split. Dated homes or homes priced too aggressively can still sit because buyers at this price point are picky. Farragut doesn't need a huge rate drop to move. It just needs good inventory, and that's still limited. All right, let's look at Lenoir City. Lenoir City is more balanced and more rate sensitive. So looking December 2025 versus December 2024, home sales were up 33.3%. Pending sales were flat at 0. Inventory was up 2.9%. The median sold price was up 14.66%, coming in at $487,287, and the absorption rate was about 3.46 months worth of inventory. New listings were down 34.3%, and the average days on the market was 46 versus 62, down around 26%. Now here's an important nuance. That big 14.66 median home price jump in a single month can be influenced by a mix of what sold, like we talked about earlier. Perhaps there were a bunch of more expensive homes that sold that affected that number. The full year number is usually the steadier read. So for the full year, 2025 versus 2024, Lenoir City, sales were up 2.5%, pending sales were up 4.3%, inventory was up 4.7%, the median sold price was up 5.06%, coming in at $457,000, and absorption was up around 10.73%, modestly looser than 2024. So Lenoir City is acting like a healthy, more balanced market. Buyers can negotiate, but good homes still move. So how about Lenoir City looking into 2026? If rates can hold under 6%, Lenoir City can feel that boost quickly because it's more payment sensitive. The first place that I would expect improvement is in pending sales because that's the leading indicator. So Lenoir City is where a 5.99% rate can actually change how many buyers qualify, so activity can expand faster. And we're going to talk more about that rate here shortly. Let's look at Tellico Village. Tellico Village is a lifestyle market and is choppy month to month. So December 2025 versus December of 2024, home sales were up 7.7%. Pending sales were up 50%. Whoa, that's a big number. Inventory was down 5.2%. Median sold price was down 8.02%, coming in at $630,000. New listings were down 39.1%, and the absorption rate was about 3.82 months worth of inventory, much tighter actually than last month. So, for Tellico Village, here's the big point. It's a lifestyle-driven market, And because the total number of monthly sales can be smaller here, the median price can look volatile from month to month. That's why you can see a December median down year over year, while the full year picture looks steadier. So let's look at the full year. Full year in Tellico Village 2025 versus 2024. Sales were up 7.2% in 2025. Pending sales were up 9.6%. Inventory was up 13.6%, and the median sold price was up just 0.4% at $630,000, basically flat and the same as it was at the end of 2024. Absorption was up 47.65%, meaning that 2025 was meaningfully more balanced than 2024. There was far less demand and more inventory, so it was a much easier time to buy in Tellico Village in 2025 than it was in 2024. So what are we watching for in Tellico Village in 2026? When you get a combination of lower supply and higher pendings, that often points to a stronger next quarter. If that pending momentum holds and inventory stays limited, Tellico could see a strong spring. Pricing is likely stable to modestly positive for homes that are well maintained and priced realistically, but anything overpriced or heavily dated may still require concessions. Tellico Village can look choppy in the monthly numbers, but lower supply plus higher pendings is usually a recipe for a stronger next quarter. As far as these locals, if people ask me where would we feel lower interest rates first, here's the answer. Farragut would feel it through the competition because it's already tight there. If rates go down, Lenoir City would feel it through affordability because there's more buyers there that will be able to qualify. And if rates go down, Tellico Village will feel it through momentum because it is lifestyle driven and pendings are already pointing to a stronger start. Earlier I talked about some big news that we were going to talk about. So now the big 2026 factor is mortgage rates just changed the conversation. Now we've got a major new variable heading into 2026. Just yesterday, President Trump announced that he wants Fannie Mae and Freddie Mac to purchase $200 billion in mortgage-backed securities with the goal of helping bring mortgage rates down and support the housing market. Well, we didn't have to wait long to see that impact because as of today, the 30-year fixed rate dropped to 5.99%, which is the first time it has been below 6% since 2023. That is a big psychological level. Whether you're a buyer or a seller or someone thinking about refinancing, starting with a 5 instead of a 6 changes behavior. So what could this likely mean for 2026 in Knoxville and East Tennessee? So here's what I expect if rates stay around this level or if they trend lower. My first prediction, more buyers re-enter the market. When rates drop, it's not just about affordability on paper, it's about confidence. A lot of buyers have been sitting on the sidelines waiting for some relief. At 5.99%, you may see more showings, more offers, and more competition on well-priced homes. Prediction number 2. Pendings and closings should improve, especially in areas with more choice. Because East Tennessee already showed strong pending growth in December, the region may be positioned to convert that into stronger closings early in 2026 if rates remain favorable. Knoxville will benefit too, but since Knoxville is already tighter than the region, the biggest change may be competition heating back up on the best homes. Prediction number 3. Inventory may not fall as fast as people expect. Even if demand increases, we still have more inventory than we did a year ago, and homes are taking longer to sell. So I don't automatically expect inventory to vanish overnight. What I do expect is that the market could shift from buyers have time to buyers need to move quickly on the right house. Prediction number 4. Prices could stabilize and some segments could start rising again. If lower prices bring back demand, The December price softening we saw, especially in Knoxville, could level out. I'm not predicting a return to the wild double-digit appreciation days, but if rates hold under 6%, we could see fewer price cuts, stronger sale-to-list performance, and modest price growth returning in the most desirable neighborhoods and in the most affordable price ranges. Prediction number 5. The market will feel more split. Even in a better rate environment, the market is likely to stay picky. Homes that are priced right, updated, in high-demand areas, those can move quickly. Homes that are overpriced, have functional issues, or need major updates may still sit, even if rates are lower. The bottom line is 2025 was a normalization year. More inventory, longer market times, and price growth cooling off. Knoxville is still tighter and faster than the region, but Knoxville also showed more noticeable price softness in December. East Tennessee's more balanced overall and ended 2025 with a bit more momentum, especially in pending sales. Now, as we head into 2026, the biggest wild card and potentially the biggest catalyst is that mortgage rates have dipped to 5.99% after the MBS purchase announcement. If that holds, it could be the spark that brings a lot of buyers back into the market. So if you're thinking about buying or selling in 2026, this is exactly the kind of rate shift that can change the pace quickly. So strategy matters now more than ever. If you're thinking about buying or selling this year, reach out to me and let's start laying out a strategy so we can meet your real estate goals in 2026. I hope this has been helpful. Don't hesitate to reach out with any questions. This is Troy Stavros with Cornerstone Realty Associates here in Knoxville. And again, Happy New Year.